Okay, good evening, good evening. May you please mute your mic so that we avoid some background noises. Okay, so I was having a look at your solution. Where is the book? Okay, I was having a look at your solution. I'm not yet done, but I marked the income statement. I think yes, you did well, except you missed something on the cost of sales, especially the impairment of the amortization. It was the impairment of brand. Okay, so I'll just have a look at the impairment of brand. That's what you missed then. Another thing was, what did you miss? Another thing was, yeah, I think that was the impairment of brand mainly. So just have a look at the information that they are saying about the brand, then I can see where you got lost. I'm also going to send you the solution so that you can actually have a look at it on your own. And I'm also going to send, I'm sure you do have F7, isn't it? You should be having F7. Where is F7? F7, 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 F7. Let me send you F7 where I took that that question, and if you can do all the questions, IAS1 questions in this F7, you'll be good to go. Okay, so I'm sending you the F7. It has got all the questions and also all the answers. It has the questions also for all other standards, the Conceptual Framework, the IAS 37, and all those other standards. You can have a look and do the practices. Okay, so today I'm just going to have a look at that question that I gave you, then I'll summarize IS1, then we can discuss which standard you want me to cover next. My network's not good. Okay, while it's waiting for it to respond. Hey. Okay, so the note about the impairment of brand is what? We have a brand in our trial balance. Yes, we have a brand. Brand it cost 1 October 2005, it was 8,000. What kind of a phone is that? All right, we have a brand that costed us on 1 October 2005, and we have a note that is saying note number, which note number? Number 6. So note number 6 saying the freehold property, the land element of 30 million. The building element is being depreciated on the straight-line basis. Plant and equipment is depreciated at 40% per annum using the reducing balance method. Sundown brand. Sundown's brand in the trial balance relates to a product line that received bad publicity during the year, which led to failing sales revenues. An impairment review was conducted on 1 April 2009, which included that, based on the estimated future sales, the brand had a value use of 12 million and a remaining life of only 3 years. However, on the same date, an impairment review However, on the same date as the impairment review, Sundown received an offer to purchase the brand for 50 million. Prior to the impairment review, it was being depreciated. Community, why do because of cash that? Hey, where you go, boys again? I know. Oh. Okay, sorry about that. Okay, so however, on the same date as the impairment review, Sundown received an offer to purchase the brand for 15 million. Prior to the impairment review, it was being depreciated using the straight line method over 10 years. Okay, so what we are going to do is can you try to do whatever you're doing gently with a noise? Ah, come on, man. You know, who's going to speak tongue? Okay, so let me open my my workbook. Where's my workbook? Okay, so I think you actually failed to apply. Did you fail to apply IAS 36 impairment of assets, or maybe the calculations of depreciation or the amortization was tricky? Okay, so for impairment, in terms of IAS 36, we say an asset is impaired if the carrying amount is more than the asset's recoverable amount. So when we do an impairment review, we're actually comparing two things, the carrying amount versus the recoverable amount. Okay, so we have carrying amount, then we have what we call recoverable amount. So on the recoverable amount, we are actually comparing two things, recoverable amount. We are comparing the value in use, and also we are comparing the value used to fair value less cost to sell. Okay, so this the total of this the higher of these two is what we call recoverable amount. Hey, my computer is slow today. Okay, so we're comparing two things. We are comparing the value in use against the recoverable amount. Okay, so the recoverable amount is the higher of the value in use versus the carrying amount. The recoverable amount is the higher of value in use and fair value less cost to sell. So our impairment will be the amount by which the carrying amount, our impairment is the excess of the carrying amount over the asset recoverable amount. Okay, so here we want to calculate our carrying amount because we are not given the carrying amount here. What we are given the trial balance is actually the cost. Then our value in use, can we determine our value in use? We are told that the value in use is 12 million. So the value in use is actually there. So we have 12 million. That is our value in use. What about the fair value? So by definition, a fair value is the price that should be received to sell an asset, or paid to transfer a liability between market participants at the measurement date. Okay, that is the definition of a fair value. Okay, so we want to determine here if we can determine our fair value from this statement. So we said the value in use. Yeah. Our value in use is 12 million. Fair value, we're told that, however, on the same date as the impairment review, we are now reading here from here. However, on the same date as the impairment review, Sundown received an offer to purchase the brand for 50 million. So this one becomes our fair value. Are we told about any cost to sell the brand? No. So this becomes our fair value. So we have a fair value of 15 million. Okay. So here, let's calculate our carrying amount, because what we are given in the trial balance is actually the cost, because they are saying brand at cost and they gave us 30,000. So the 30 million, this is actually 30 million because we have this zero. So it's 30 million. The 30 million is the cost. So how we can calculate our carrying amount? We are going to say the cost, which is the 30 million. Then we say less accumulated impairment. So how are we going to calculate the accumulated impairment? We are told that the brand was bought 1 October 2005, and now we are doing the impairment assessment when we are doing the impairment assessment on 1 April 2009. So how many years do we have here? We have 2000 and let me admit one person. This is a new one. Okay, so we are saying the brand was acquired 1 October. So we have 2005, 2006 is 1 year, 2006, 2007, so another year, 2007, 2008, another year, 2008, 2009. It's not a complete year because we did the impairment. I think was it half year. It was on 1 April, so it's October. Our year is starting when? Our year is starting October, so it's October, November, December, January, February, March. So it's 6 years. We are doing the impairment assessment as at this date, so it's 6 years. So it's our 3 complete years plus half year. So we have 3.5 years from the date we acquired the brand up to the date when we are doing the impairment review. So we are told that prior to the impairment, it was being depreciated using the set method over 10 years. So what it means is the cost that we have here, we are going to say the cost, then we are going to say is equal to our cost here, which is 30 million. Then we divide it by 10 years, which is the useful life. Then this will be our, did I do it correctly? Or is it not producing the correct amount? Okay, no, this is not 30 million. This is not 30 million. Okay, so our yearly, let me do this here. Our yearly amortization is 3 million. So we had 3 million for how many years? For 3 full years. So it's 3 million multiplied by 3 years, then plus 3 million multiplied by 6/12 for the that half year. So that means we amortized our brand for this much. Let me paste special, paste these values. Okay. So that was the accumulated amortization on the brand when we did the impairment. Just a refresher, we said we acquired the brand on this date. We acquired the brand on 1 October 2005. So we said that was at the beginning of that year. So 2005, 2006, it was 1 year, 2006, 2007, another year, 2007, 2008, another year. Then 2008, 2009, we are doing the review half year. So that's why we said 3.5 years. Okay, so I think it's correct. So this is our accumulated impairment on the brand. Then if you say the cost less the accumulated impairment, we have 19.5. So this was the carrying amount when we did the impairment. This was the carrying amount when we did the impairment. Okay. So we are now comparing the carrying amount, this figure, to the recoverable amount, this figure. In the recoverable amount, we said is the higher of these two, the value in use and the fair value less cost to sell. So in this case, our recoverable amount is actually 15 million. So carrying amount is 19,500 and recoverable amount is 15 million. So that means our carrying amount is more than the recoverable amount. So we have an impairment. So impairment will be equal to the excess of the carrying amount, which is 19 million, less the recoverable amount, which is 15 million. So our impairment should be 4.5. Yes, it should be 4.5. According to my calculations here, it should be 4.5, the impairment. And then on your answer, you had, how much was it? On your answer, you had, what was it? What was it? You had 6 million. I don't know. Were you doing like what I was doing? I was just doing here, or you did something else? Maybe you can just confirm. Did you follow that thought process?
Yeah, yes, we did. Actually, where we made a mistake is the 6 months of where we said 6 over 12 times 30 million over 2. That one we accounted for later on, not on, we did not subject to the impairment for the 6 months, the first 6 months of the year. We accounted for it like when in the PPE, not on carrying amount. I think that's where we made an error.
Oh. Okay.
So we ended, yes, the 1.5 is in the PPE, not the.
Oh, the 1.5. Of course, it should be there because it should. Okay, for the last part, we are not going. It should not be 1.5 because now our new carrying amount will be this amount. Will be the 50 million. So we are now charging the impairment on the 50 million. So I don't think it will be 1.5. Will it be 1.5? It won't be 1.5 because how many years do we now left? We are left with 6.5 years. So if we say this one divided by the remaining life, which is 6.5. Is it so? Because now our revised carrying amount is now 15 million. We are reducing this carrying amount of 19.5 to 15 million because that's our recoverable amount. So there is an impairment of 1 point something. So when you are now calculating, because we are doing this impairment review half year, So we also want to calculate amortization from 1 April when we did the review up to year end, which is 30 September. So the impairment, we are no longer calculating it on 30 million, we are now calculating it on 15 million, our new carrying amount. But it's very important if you can just, another thing that I noted on your answer sheet is that whenever you are doing those notes, you should also put Theo to say whatever that you are doing, to say, okay, here, like your note 7, the cost of sales, you just say balance per trial balance, that was correct. Then amortization of brand. We want to see where you actually calculated your calculations on the amortization. Yes, it's actually, is it there? Yes, it's there. It's there, but the calculations was not quite correct. Okay, so it was 30 million divided by 10, which is 3 million. Then multiplied by 6 over 12, which is 1.5. Then we have 15 million divided by 3 years. Multiply by, I don't know where you were getting 3 years. 15 million divided by 3 years, whatever. I'll mark and then I'll give you your book tomorrow. But that is the thought process. You should document everything when you doing your notes. You don't just put the figures or whatever. You should also put to say in terms of IAS something, we are going to amortize it using this one, and then blah blah blah. I'll show you on OneNote what you are supposed to do. Okay, but that was the presentation generally was not quite bad. The deferred tax one, I think it was correct. Just you said balance per trial balance 5.4, balance D. The deferred note is not right. Okay, I'll show you how you can do at least one note. Okay, so let's calculate what is it? Let's calculate the deferred tax one, this note one. I'll show you how you can put your working. Okay, so here we say not, this is to maximize marks. So let's say note number 8. We say, let me do the income tax one. Income tax expense. Okay, so what we are going to do, we are going to say our current tax, we are going to say our current provisional tax. We are given that this one is given. We are told that the directors here have estimated the provision for income tax for the end of 3rd September to be 16,200. So you are going to put your 16,200. Then you say we are adding under or over provision. This one we calculated. I showed you how you determine whether this amount in the trial balance was an over or under absorption, and we concluded that it was actually an under absorption. It's 2.1 thousand. So it's used to increase our current tax for this year, our income tax. Then we have the issue of increases or decreases in deferred tax. Okay, increase on decrease on deferred tax. Now I showed you how you calculate it. We have this deferred tax liability of 5.4 million. Then you compare it to our closing deferred tax. How do we calculate our closing deferred tax? We say the 30 million, which is the excess of the carrying amounts over the tax base multiplied by the tax rate. So we say is equal to 5,400. Okay, so 5,400 is our deferred tax BD. deferred tax DD. Then we have deferred tax CD. We want to calculate deferred tax CD. So we say it's 13 million multiplied by our tax rate is 0.3, which is 3.9. Then the difference, it is a decrease because last year we ended up with a deferred tax liability of 5.4. Then this year we are ending up with deferred tax of 3.9. So the difference is equal to, because it's a decrease, it will reduce our income tax expense for this year. So the total of these ones becomes our income tax expense in the statement of profit or loss and other comprehensive income. So this one we are taking it to the profit or loss account as income tax. Over and above this one, this is a correct note, that's what you were doing, but you should disclose why you are adding this over provision instead of subtracting it. You don't assume that the examiner knows that we should add an under provision or over provision. You should put a note to say, maybe just below your calculations, you can say an under provision of current income tax is used to reduce, an under provision for current income tax is used to reduce okay, from prior year is used to increase current year's income tax. Okay, this is the first note. Second note, you are explaining why we should use the under provision to increase current year's income tax. So this one, I want to throw the question to the floor. Why do we have to add the 100? I explained this yesterday. So why do we have to add the under provision instead of subtracting it? If anyone can volunteer. We have Nitt-Gritt. Nitt-Gritt volunteering. Why do we have to add an under provision? Anyone? Pamela? Okay, Bridget, why do we have to add an under provision?
So, if I get you correctly, you said would just provided for tax. Suppose when we are calculating tax due to Zimmer, then we make a provision, say for 10,000. Then when we submit our financial to for our income tax, whatever computation to Zimmer, then Zimmer says probably say you are going to pay 12,000. So the 2,000 will be the other provision that we need to add on because they sort of provided for tax, but which is lower than what Zimmer actually wants from us.
Exactly. That was exactly the point. So you can document. If you want to be a distinction student, that's what you actually do. You document why we have to add the other provision. In this case, just document the other provision because that's what we have here. And also you can just put a note to say an increase in deferred tax, we deduct it from the current provisional tax in order to arrive at the income tax expense for the year, and you also document the reason. That is if you want to maximize your marks. Okay, maybe you copied instead of copying 100, you actually say 200. But if there is this note, it shows that the student actually knows what she was doing but maybe she just copied the amount incorrectly. So instead of marking the incorrect amount, the examiner will mark the not. That's why I encourage you to put the theory just beneath the notes. Okay, that was it. But generally, I think the presentation was correct. And another thing is, you start with the requirement, then you put the notes there after the requirements. So on your answer script, you were supposed to put. I was supposed to say income statement first, then followed by the balance sheet. Then the notes will be under those requirements. Because now I started marking the workings, but the first thing that I was supposed to see was supposed to be the income statement, not the workings. The workings will be supporting the income statement. Your requirement was to calculate the income statement, isn't it? And also the balance sheet. So you're supposed to put those first, then the workings second. That's what you do. That's what you are supposed to do. That's how it works. Okay. So, but generally, so I'll do the marking. I'll also, isn't I sent you that F7? That's where I took the question, and also the solution is there. And there are many practice questions. You can do the practice at least every day up to when you will start writing. At least do one question on IAS1, and make sure that you set your time limit. 30 minutes is enough for one question. So if you cannot finish that question in 30 minutes, there is a risk that in an examination situation, because you will be having only 3 hours to answer 4 questions. And they bring this IAS1 intentionally to see whether you can manage. It's not like that. It's not like the standard is difficult. They are actually testing you on whether you can manage your time, because generally you see that the questions are very simple, and also the adjustments, they are simple. The adjustments are simple. Okay, so this is actually the solution. So that your revenue was correct. The cost of sales was a little bit incorrect because of the amortization. Then your distribution was correct. These other ones were actually correct in the income tax. As you can see here, they said the provision plus 200, which is the under provision, then minus 1,500, and they are referring us to working number 6. So if we go to working number 6, yeah, okay, so we're calculating the impairment of brand. As you can see, the impairment of brand is here, the 4.5 that we're calculating. Wait, was I calculating? Okay, this one. So take note of how I was calculating. I think so. Your problem was only on the dates. I think so on numbering them, on counting the dates and the months. But I think the thought process, it was actually correct to say we compare the carrying amount and the recoverable amount, and the recoverable amount is the higher of the value in use and cost to sell, fair value cost to sell, and whatever. Okay, so that was it. So they're saying the brand is being amortized at 3 million per annum, which is 30 million divided by 10. The impairment occurred halfway through the year. Thus, amortization of 1.5 should be charged prior to the calculation of the impairment loss. At the date of the impairment review, the brand had a carrying amount of 19.5. I think, did we provide? Yes, the 9.5. Then, which is 30 minus 9 plus 1.5. The cover-up amount of the brand is its fair value, which is 15 million, as this is the higher than its value in use, given an impairment loss of 4.5. Amortization of 2.5. Yeah, take note of this one. Amortization of 2.5 million, which is 50. Now we are dividing the new carrying amount. We did the impairment review and we established that our new carrying amount, which is the fair value, is 15 million. So we are dividing it by 3 years. Then we multiply it by 6/12. So they are calculating the impairment on the revised carry amount, which is our fair value. And why are they using 3 years? Let me see if there is a note why they are using 3 years. Maybe I missed that note. Okay, they are saying an impairment was I want to see why they are using. Initially, they branded 10 years back then when it was acquired in 2005. Sundown branding trial balance ratio that received during the year led to an impairment review was conducted on 1 April, which concluded that based on the estimated future sales, the brand had a fair value of in the remaining use or that's why they picked 3 years. Okay, the remaining useful life of 3 years. That's why they said the revised carrying amount divided by 3 years. Okay, that is it, ladies. So in a nutshell, okay, do we have any questions on this one? On that question specifically before we do our summary? Okay, I'll take the silence as a no questions. Okay. So I'll also send you this one. This one is a good summary. Instead of reading the whole standard, you can use this one. So this is just a summary. This page only is the summary of IAS 1. So what you need to know are the components of financial statement. This one we discussed about this one yesterday. And we said we have the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changes in equity, the statement of cash flow in the notes. Those are the 5 components, and they are required. Then we also have these other considerations. These are very fundamental. I'm not sure at your level whether you should be doing this, but it's very important. Maybe they just ask you about other requirements. They can give you like financial statements of a company and it's the disclosures. Then they'll ask you whether that company is compliant with the requirements of IAS 1 presentation of financial statements. So you are actually checking those things. IAS 1 says whatever that you are putting in the financial statement should be fairly presented and in compliance with IFRS and IAS. So how do we know that the financial statements are actually fairly presented? That's when the auditors comes in. So when you are given the financial statements, what you can actually do is you go straight to the auditor's report. So if they disqualified the opinion, I want to believe that you are doing auditing. So if I say if they disqualify, you understand what I am trying to mean. Are you doing auditing? Of course, you are auditing. Okay. So if they disqualify, or if they qualify, or if they disclaim, disqualifying and disclaiming is the same thing. If they qualify the opinion, that means they are the financial statements are misstated, isn't? So you can say that they are not compliant as far as our first requirement is concerned. Another thing you can actually go through on the disclosures, the first note should be about whether the financial statements are in compliance with the requirements of all IFRS. That's another option. Then we know that the financial statements are prepared on a going concern assumption. So going concern, basically we are saying an entity is going to operate for the foreseeable future. And the foreseeable future for this concept sake, it will be 12 months, for the next 12 months. So when you are preparing, when the company is preparing its financial statements, they are preparing it on a going concern assumption. So this one, in terms of the conceptual framework, is called the underlying assumption when you are preparing your financial statements. And also, so IAS 1 now says financial statements are required to be prepared on a going concern basis unless the entity is in liquidation or has ceased trading or there is an indication that the entity is not a going concern. So what happens if an entity is not a going concern? You are going to present your financial statements at realizable value. So if it is PPE, you are no longer going to say the cost minus carrying amount minus accumulated impairment, cost minus accumulated depreciation minus accumulated impairment, but rather you are going to look at the amount that you are going to get when you sell the asset now. That's the amount that you are going to disclose because the company is not a going concern. Then another one is the accrual basis of accounting. We're saying entities are required to use accrual basis of accounting except for cash flow information. So we know the accrual basis of accounting, the definition in layman's language, we say the accruals accounting, we are actually recognizing, this one is not paid the layman's language, but in terms of the conceptual framework or IAS1, accruals accounting, we say we recognize assets or financial elements when they meet the recognition criteria per the conceptual framework. That's how they actually define the accrual basis of accounting. But from our previous studies, we know that the accruals accounting says you recognize the financial elements not upon receipt of money, but upon, like let's say we sell goods on credit. Before receiving the money, we can actually say we have made a sale, but we have not yet received the money. So in such doing, we are applying the accrual basis of accounting. And in terms of the conceptual framework, we say the definition is that we recognize the financial statement elements when they meet the definition and the recognition criteria as set in the conceptual framework. Okay, where is the conceptual framework? Okay, so we said the conceptual framework, you are doing it for the 2018 one. We used to have the 2010 one, but now is outdated. It was updated to 20. Okay, forget about that one. Then the second one is the presentation consistency. So we are saying an entity is required to retain presentation and classification from one period to the next. So what the standard is trying to say here is if you were measuring, subsequently measuring maybe investment property at fair value, you should continue measuring the investment property at fair value year after year, unless it is clearly no longer reasonable to continue measuring those fair value, those investment property at fair value. That's when we are talking about IAS 8, changes in accounting policy or changes in accounting estimates. But really, according to IAS 8, we say you can only change a policy if that change will result in financial statements that are fairly represented or presented. So it's really, we don't normally change our policy. Yes, the estimates we can change, but the policy, we don't normally change the policy. Like let's say we are depreciating our assets using the straight line basis, we cannot just jump to say we are now measuring using the reducing balance or sum of digits or whatever other methods. That's what the requirement is talking about. Then another requirement is about materiality and aggregation. We are saying each material class of similar assets and items of similar nature of function is to be presented separately. Okay. So when you see your balance sheet, when you are saying assets, then you put all the assets there, and then the current liabilities, and then equity, blah blah. We're actually applying this one. Then we have offsetting and comparability. You can read on this one. I'm going to send you this, but that's it in a short. Then it also define what is a current asset and what is a non-current asset. You have to know this. And then also the definition, the minimum content of a statement of comprehensive income, and also the statement of changes in equity, and also the cash flow statement. But the cash flow statement, we don't have a detail here because it is covered by an entirely different standard. Okay. So what is a current asset? We say in terms of IAS1, okay, before I actually leak, say it out, I want one person to just give me the definition. What do you think is a current asset, Bridget? Do I have people in here? Okay.
Yes, I am.
Okay, what is a current asset? Okay, I think for current assets, look at your balance sheet. We have inventory, we have debtors, we have cash and cash equivalents, we have prepayments. What are those? Okay, so a current asset, we are saying this is the correct definition. If you are required to define a current asset, you said current assets are assets that are, number one, expected to be realized in or is intended for the sale or consumption in the entity's normal operating cycle. Number two, held primarily for trading. Number three, expected to be realized within 12 months. Number four, cash and cash equivalents. That is the definition of current assets. What about non-current assets? The definition of non-current assets, the IAS1 say all other assets that are not current assets should be classified as non-current assets. So we don't actually have a definition for non-current assets. So all the other assets that are not current assets are non-current assets. That's the definition. So to define a non-current asset, you should know the definition of a current asset. Okay. Eh?
Ziri kutona basi unonazo zitora kana wakudai.
Unenge ivo haichatoupload ipaishovuka because ine hembe dzako autondaendaide manaka. Okay, sorry about that one. Where was I? Okay, so you should know the definition. The same applies to the definition of current liabilities. We say expected to be settled. A current liability is current liabilities are expected to be settled in the entity's normal operating cycle, held primarily for trading, due to be settled within 12 months. The entity does not have an unconditional right to defer settlement of the liability for at least 12 months. And then the definition of non-current liabilities, we say all other liabilities that are not current liabilities should be classified as non-current liabilities. That's the definition. Okay, so it also sets out the minimum requirement of IAS1 of the income statement. That's what we actually did, and also the notes. Okay, so that is IAS1 in summary. So I'm also going to send you this one so that you can, it summarizes all standards. We can go to IAS2 inventory, we have the summary. We can go to IAS7 statement of cash flow, we have a summary. We can go to every standard, there is a summary for that standard. Okay, so do we have any questions?
No question.
Oh, no questions. Okay. So which standard should we cover next?
I'm not sure about others, but now maybe challenges when IAS 23 borrowing cost.
Okay, so we cover borrowing cost tomorrow because we are only the one who is participating. So we are going to cover borrowing cost tomorrow. Okay, that's fine. The same time, 7 o'clock. Please be punctual. Otherwise, have a good day.
Thank you.